Money. We use it every single day, but have you ever really stopped to think about what it is or where it even came from? Well, in this explainer, we're going to go on a journey through thousands of years of history to figure out how we got from trading cows to trading code, and what all of that means for our future.
So let's just start with that big fundamental question. What is money really? Is it just the paper in your wallet or the numbers you see in your bank account? Or is it something more abstract? An idea, a piece of technology, or maybe just a collective agreement? The truth is, the answer to that question has changed like crazy throughout history.
All right, to understand where we are today, we've got to go way back to the beginning. So in this first part, we're going to explore a time before coins, before cash, and see how humanity first tried to solve the basic problem of, how to trade stuff.
Isn't that wild? It's amazing how our ancient past is still baked right into the words we use for money today. For thousands and thousands of years, the most common form of money wasn't shiny metal. It was stuff that everybody agreed was valuable. And cattle? They were like a walking Swiss Army knife. You got milk, you got meat, you got labor. They were the original piggy bank, the original store of value.
Now before that, the system was just simple barter. But honestly, it was a huge pain. It's incredibly inefficient. Just imagine you're a fisherman and you want a new spear. You'd have to track down a spear maker who also just so happens to be craving fish right at that exact moment. This problem, this double coincidence of wants, makes any kind of large-scale economy basically impossible.
So this timeline kind of lays out the whole journey. You can see how we went from bartering actual things to using stuff everyone wanted, like cattle. Then we made another leap, abstracting that value into something more durable and easy to divide, like gold and silver coins. Then came the printing press, which let us create paper notes that represented the gold sitting in a vault. And then, in 1971, something happened that changed absolutely everything.
In 1971, the US government completely cut the dollar's connection to gold, and with that one move, the entire global money system was turned on its head. We all entered the age of fiat money, which is just a fancy way of saying money that's based on nothing more than trust.
This is so important to understand. The dollar bill in your hand, it has no value on its own. It's not backed by a physical thing. It only has value because the government says it does. And maybe even more importantly, because we all believe it has value. We agree to accept it as payment.
It's a pretty mind-bending idea when you stop and think about it, right? Our entire global economy is basically running on humanity's most successful story, a shared belief that these pieces of paper and these digital numbers are actually worth something. It works, but it's all built on faith in our institutions.
And here's another thing most people get wrong. Most new money isn't printed by the government. Nope, it's created basically out of thin air by private banks. When a bank gives you a loan for a house or a car, it doesn't pull that money out of a vault. It just types the numbers into your account and poof, new money is created that didn't exist a second before. This makes our money supply really flexible, but it also means it's potentially infinite.
And that flexibility, that ability to create money with no limits, that leads us right to the core weakness of the whole fiat system. In this next part, let's look at what happens when that trust, the very thing holding it all together, starts to crack.
We've all felt this, right? It's called inflation. And simply put, as the supply of money goes up, the value of each individual dollar goes down. It's this slow, quiet erosion of your purchasing power, and it's a built-in feature of the system we live in. And in extreme cases, that slow erosion can turn into a complete and total collapse. Just look at Zimbabwe. Back in 1980, their dollar was actually worth more than a US dollar. But when the government lost control and just started printing money like there was no tomorrow, that collective belief, that trust, it just evaporated. The currency became completely worthless. This is the ultimate danger of a system that relies purely on trust in a central authority.
So it was right in the middle of the fallout from the 2008 financial crisis, another huge crisis of trust in the system, that an anonymous inventor named Satoshi Nakamoto released Bitcoin. It was put forward as a kind of digital answer, a technological solution to the problems that are baked right into a centralized, trust-based financial system.
This chart really cuts right to the heart of it. Fiat currency, controlled by governments and banks. Bitcoin, run by a decentralized network of computers all over the world. The supply of fiat, potentially unlimited. Bitcoin, there will only ever be 21 million. And here's the big one. Fiat requires you to trust in human institutions. Bitcoin asks you to trust in open source code and pure mathematics.
So these are the core ideas that give Bitcoin its potential value. Its absolute, undeniable scarcity makes it a potential store of value.
a way to maybe protect your wealth from inflation. It's a borderless way to send money. And because it's decentralized, no single person or government can stop a transaction or seize your funds.
This is the analogy you hear all the time, and it actually makes a lot of sense. Like gold, Bitcoin is very scarce. And, just like gold, you have to spend real-world energy, in this case, massive amounts of electricity and computing power, to mine it. This proof of work gives it a real cost of production, tying it to something tangible, kind of like digging gold out of the ground.
So, you're probably wondering, how can all this possibly work without a bank or a government in charge? Well, the answer is a groundbreaking technology called the blockchain. You can think of it as an unbreakable digital ledger.
Imagine a global accounting book, one that everyone can see, but that nobody can change. That's the blockchain. Every single transaction gets recorded in a block, which is then cryptographically locked onto the previous one. This chain makes the entire history of transactions permanent and basically tamper-proof.
Okay, here's how it works. Simplified. When you send Bitcoin, that request is broadcast to the whole network. Miners grab your transaction along with a bunch of others. Then they all start racing to solve a really complex math problem. The winner of that race gets to add the next block to the chain, which validates all the transactions inside, and your payment is settled. It's a system of global consensus that doesn't need a boss.
Of course, we can't talk about Bitcoin without talking about its price. As you can see from this chart, it's famous for being, well, volatile. The price can shoot up or crash down in a really short amount of time. This makes it exciting for traders, sure, but it also makes it really tough to use as a stable, everyday currency for buying something like a cup of coffee.
But if you zoom out, way out, like this logarithmic chart does, a totally different picture emerges. Yeah, there's a ton of short-term noise and crazy swings, but the long-term trend has been one of pretty consistent growth. And this is the core of that digital gold argument, that while it's wild day to day, over the long run, its scarcity could drive its value up, making it a potential hedge against the steady inflation of traditional currencies.
So here we are. We've gone from physical things to government promises, and now to a system based purely on math and a distributed network. Each step was a huge leap in how we think about value. The question that leaves us with is, what's the next leap? What does the next chapter in the long story of money look like? And what role will we and our trust play in writing it?